YouTube लाइव चल रहा है, तो द थिंग इज दैट व्हाई वी आर डूइंग दिस, want everyone to later on if somebody comes back, I was there, so it will be on record. मेरे पास So can we start with the first group? Rishi?
Sir, now first group नहीं आता.
Yeah, Rishi wants to leave early, therefore.
Rishi does not want to. Rishi, sir, sequence one से लेके सर. Yes, four.
विक्रम. So guys, जल्दी से खत्म करेंगे so that we can start with the remaining task as well, and this will carry 5 marks. Now those people who are present, whose attendance is more than 50% only are going to get marks for attendance. As per ma'am, it is told that the people who are having attendance below 50%, उनका the respective coordinator will take the decision, लेकिन वो डेटा विसा में नहीं दिख रहा है. जो अटेंडेंस जो है वो अटेंडेंस तो जो डेटा विसा में दिखेगा वो हिसाब से जो भी पेच होने वाला है उतना ही आपका मार्क्स आने वाला है. तो आई एम ट्राइंग माई लेवल बेस्ट कि यहाँ पर आपको मैक्सिमम मार्क्स मिले. ओके, कम ऑन गाइस, ग्रुप नंबर 1 प्लीज. It is more time. Please come together. Yes. So this is going to be on a record, no? Please. Now it doesn't make a difference how you are performing. So please try to understand. It is not making a difference how you are performing. But you are performing in X tempo. It's going on record. चलो बट चलो, my dear friends, and you can use both the languages, but then I mean you can go bilingual, but then maximum English, because our language of instruction is English. Huh? वो तो फॉरेन लेटर है भाई.
सर इसका भी क्लोजअप.
नहीं, क्लोजअप किसका भी नहीं दूंगा, वो तो अपना पहचान वाला है.
सर
The respective group will place the signature after their presentation. साइन दे देंगे. अगर आपको चेयर रखना है उधर, ये करना है डाइस पे, अगर खड़ा रहना है डाइस पे खड़े रहो. ओके, नो इंट्रोडक्शन नीडेड.
Firstly, I'll tell you when was the new tax regime set by the government. It was 2020.
it is equally important for everyone to now listen to them as well. Yes.
The old tax regime helped people to invest and offered a lot of support via the government. People had this mentality that investing would save their taxes, and that was true before 2020. But after 2020, it is not like that. People don't invest to save taxes, they rather invest to save for their future.
So now I will tell you about what are the major changes in the tax regimes and what are major include. So some of it include the names of it include 80C, section 80C, 80E, 80G. I'll tell you more about it, what all these sections mean actually. So there are various sectors in which the tax regime has affected. One is investment, the other is insurance, loan interest. So earlier, in the old tax regime, the tax rate were lower, but major reductions were given. But this in the new tax regime, the rates are higher. Sorry, the rates are lower, but the reductions have been removed. So the taxable income is now lower compared to the previous tax regime.
Benefits of tax saving investment, which like in new tax regime, which are not available in old tax regime. First is boost insurance and social security coverage. Like in health insurance, like 25,000 is for self insurance and self insurance, and for 50,000 for old citizen. Old citizen members. And
I will be speaking about challenges. First, it reduces saving, as earlier people used to have options in saving options like provident fund and employee provident fund, but because of it, it may reduce their saving options and they may spend a lot. Second option is impact on real estate, as they provide home loans which are benefited for middle class families, and it may reduce buying houses also.
Old tax and the new tax regime. Get the conclusion the new old tax regime is beneficial for the invest for the long terms, and the new tax regime benefits for the short terms and the
Okay. So my basic question now, you said that you said that the old tax regime were giving more benefits, more chances for the investment, right? That is your basic opinion, right? So now is it like that because of new tax regime, people are saving less? Do you want to conclude like this, or they are able to save more?
I think people that was on people's choice. People before used to put their invest because they wanted to save taxes, but now they invest because they want to save for their future.
Yes.
The game has changed, but the people are still saving.
People are still saving. So which one is better according to you, please? Which one is better according to you? New tax regime, when it comes to you people are you people are you have already gone for wealth management subject. You are now doing personal financial planning. Now, what is your blatant opinion? I don't want to support your opinion with any facts and figures, but if you want to conclude, which one would be better according to you? Being the people representing current generation, what do you feel? Which one is better? The new tax regime or the old one?
The newer one is better, and even though we are giving the taxes are higher for the people's point of view, but the tax rate are low. So इतना कुछ हमारे तरफ से so it's a win for us, as well as the government is also getting taxes. So it's a win for the country.
Very nice.
Also, when from our perspective, the young generation, the newer tax regime is better because the young generation currently doesn't have a lot of money to invest after
Anything which you want to add into their points? Okay, thank you very much. Very nice one. So group number 2. Yes. So we don't need any kind of introduction. The reason is, that we are trying to save our time. What is your subject like, and then you start. What is the subject you are going to talk upon?
Okay, today our group is going to talk about the challenges of personal financial planning of a salaried person that resides in a metropolitan city. So to begin with, in short, I'll just explain what personal financial planning is. So it can be described as a process of managing income, expenses, investment, and savings for a salaried person. It can refer to paying monthly EMIs or planning on a long-term investment such as buying a car, buying a house, etc. And in metropolitan cities like Mumbai, Bangalore, and Delhi, the basic challenge that comes to our mind when we talk about this is the cost of living, or you can say expensive housing. To cope up with this, a person needs to analyze each and every aspect of his salary and need to allocate funds accordingly. So, further challenges in this.
So the second challenge is the expensive housing. Usually the housing is one of the biggest burden to the metropolitan city. A salaried person often spend 30% to 50% of their salary on the rent, and if they buy a house, they have to pay a long-term EMI for 15 to 25 years. Buying a house in metropolitan city becomes very heavy, becomes very expensive without heavy loans. So this also creates a problem with the financial planning for saving long-term for saving for long-term goals. Then the third financial problem that faces is the lifestyle inflation. Lifestyle inflation is a tendency to increase the spending of a salaried person with an increment in the salary. Often a person spends more in metropolitan city because there is more exposure of malls, branded brands and different entertainment sources, which increases the expense of a person. Then the last challenge would be social and peer pressure. One of the most important challenges is that there is a lot of social and pressure and peer pressure for a person in metropolitan city. They often compare themselves with their colleagues and friends, and that leads to unnecessary expense on vacations, gadgets, and
So the other challenges are job instability and high career competitions. So basically in metropolitan cities, there are a lot of competition in career-wise. There is no growth, and what they do for growth is basically go for higher studies and mostly try to do courses and get certificates. But if they go for in present, they will get a lot of pressure on the money, like the funds, but it would benefit in them in future. And because of this, it's difficult to get a financial planning, certainly right now. And the first one is, so the other is job insecurity. And it's because in metropolitan cities, there are private jobs. They are not guaranteed basically because of layoffs and companies restructuring and other many more. But because of sudden unemployment, it would pressure the salaried person because he doesn't have any savings for it. So, Joshua, what do you think?
Next one would be a debt burden, and debt burden is because you get easy access to credit. Now in metropolitan cities you have buy now pay later service, then you have credit cards, a lot of banks that will give you loans and debts, which eventually turns into debt, and because it's already living expenses are high, becomes difficult, and usually people fall into that burden and they have for which to pay one debt they take another loan, and that happens and it snowballs to a bigger effect. Second would be you have less discipline when it comes to saving or investing. That is because again debt burden and the financial constraints that are already there adds up, and eventually people forget to save, and within the lifestyle matters. all this becomes a very bad habit where people don't save but spend everything that they get.
So I will talk about the medical expenses and financial awareness. So the medical expenses in the metropolitan cities are actually very high. Without proper health insurance, the individuals will need to take loan which may affect their long term. Second, I am going to talk about the financial awareness. So the individuals do not have the awareness about the tax planning, savings and investment because of the high cost of living.
Close, stand close together. So what do you think, what currently is a solution for the metropolitan people, like the people who you are also representing the generation Z, which is going to go on a job very soon after your graduation. What, looking at all these challenges and after understanding all these challenges, what do you think, what solution can you give? What solution can you give so that the people will be able to, any kind of a solution, any small solution which people can actually utilize in their daily habit, and they can make one addition of a penny toward their saving? Diversification of a income.
Diversify your income, start investing early, and if possible, try to upgrade your skills, learn more, so that you get a better and secure job. Apart from that, focusing on, strictly your lifestyle, so that you don't spend so much when unnecessary, start saving more often. And if possible, there are a lot of people who, after, they get tired of metropolitan cities, they eventually move out, or have another place where they can settle eventually. But basic idea is learn more, so that you can get a better job. And with that, diversify your income so that you have multiple income source, strategy, either investing or, businesses or something where you have a lot of income streams so that you don't bottom.
So for if there's an SIPs which could be used in future, this is my solution.
Another challenge is which can be taken into consideration.
Talk me about any solution.
No, the challenge that we're facing and the solution we have towards it is people after becoming a salaried person, they tend to get into a lot with comparing themselves, their lifestyle with other people, and that is one of the major reasons they increase their expenses a lot and buy things and spend on certain things which are not needed, which that can be avoided to maintain and save more and invest in further things.
Last solution that can be taken into consideration is when a person is not able to decide what and how the finances are to be allocated, they can ask for advices or guidance from a financial expert so that they can allocate their funds effectively and can make themselves stable and the finances also can be stable.
Very nice, commendable one. Thank you very much for your contribution to our knowledge. Please sign across. Group number 3. Come from this side, please come from this side. Is it okay for you to? Will it be okay? Will you come from this side? Or write down the name of a topic also on which you have given extempo. So I welcome you all on the dais. Where's the fifth one? You are a fourth? Okay. You all are 5. Please stand little closer. Okay. So I don't need any kind of introduction. You please introduce, anybody amongst you can introduce your topic and then extempo start.
So today me and my group is going to present on the topic financial ratios and cost in financial planning. So we all know financial planning is very important in today's life because it helps us to know that where we have to invest, what is our budget, how to do the savings, incomes and etc. Now to understand whether our financial planning is stable, like that is strong or weak, we have financial ratios. So these are the indicators which help us to know that our financial planning is going well or not. Now when I talk about financial ratios, the very first ratio which comes in our mind is how much income we are saving, and there comes our savings ratio. So saving ratio is basically the amount of income that is left after spending money on our expenses. The formula for saving ratio is the total savings upon total income. So saving ratio is basically the ratio that comes, like we have various expenses in our day-to-day life. And after all the expenses are done, the amount which is left, that's known as saving ratio. For the saving ratio is important to have future need like emergency funds, then future growth for investment, and saving ratios plays a very important role in today's life.
So secondly, I'll be covering the debt ratios. Debt ratios are of two types. There is debt to income ratio and there is debt to asset ratio. So for debt to income ratio, the formula is the monthly debts divided by the monthly income. And this basically shows us how much portion of our income is covering our debt. This includes our EMIs, our credit card dues, and our personal loans. And the ideal debt to income ratio is considered 36%, and the lower it is, the better it is for us. And if it goes more, then it is considered to be more riskier. And secondly, coming to the debt to asset ratio, it shows us how much of our assets are financed by our debts, and the formula is total liabilities divided by total assets. And again, the lower it is, the better it is considered, and it basically shows a person's long-term financial stability.
Okay, so I'll be talking about emergency fund. Emergency fund ratio is one of the most important ratio in personal financial planning. It measures how many months a person can survive without proper income. For calculating this, the formula is to divide liquid asset by monthly expenses. The higher the ratio comes, minimum 3 to 6 months, the more secure you are. For example, if a person is having liquid asset of 1,80,000 and its monthly expenses is around 30,000, the emergency fund ratio come up to 6 months, which is proper and balanced. It is important to have emergency fund as it protects us from medical emergencies and unexpected situations. Without having a proper emergency fund, people would want to waste, people would be having more financial burden using loans and credit cards.
The next ratio is investment ratio. So the investment ratio is a financial planning tool that shows how much of your money or property is invested in growing or earning income. It helps you to understand that you're growing enough money for your future, for a better future. It is calculated by dividing your total invested assets by your total assets. If it is high, it means that you have invested enough and are growing for future. But if it is low, it means that you're not growing enough for your future and you're tied up your money, most of your assets in house or car.
Okay, so now let's have a look upon net worth ratio. So this ratio is very crucial when it comes to personal financial planning, as this ratio helps us to understand a person's financial stability and strength. So this ratio is calculated by dividing net worth by total assets, and the net worth is calculated by deducting liabilities of an individual with his assets. So when the net worth ratio is greater in positive, above 50%, it is considered that a person is financially stable, and he has less dependence on borrowed funds. And whereas when the ratio is in negative or less than 50%, it is considered that the person is in financial risk. This ratio is help a person to understand the financial independence, managing debt, and also for long-term wealth creation. Thank you.
So if I want to ask one question. Now you imagine there is one particular person who is earning a salary of, say for example, 1 lakh rupees a month, and he is thinking of buying mg hectare for that matter. Now you approximately cost of mg hectare comes around somewhere 19 lakh to 20 lakh. What advice would you give? Now he is the sole earning member. So is it possible for you to, to convince him not to buy the car by showing any of such ratios? What type of ratio will you be using if you want to really deter him from not making investment. Now you're for sure, if I am investing in a car which is having a value of 19 lakh around, then my almost monthly expenditure on installment will be somewhere coming around 42,000 to 44,000 around. Okay, forget about the car running cost and all. But then looking at this particular figure, obviously, what would you advise him? Should he go for a car or should he not go for a car?
After looking to our savings ratio, and that we afford the car or not.
Okay, saving ratio. Any other ratio?
Also, as I mentioned, he's the sole person who's earning, so it might be recommended that he calculate the emergency fund ratio as well, depending on his asset and after investment, the amount that is left.
Okay, any other ratio? Okay, thank you very much. Have a nice time. It was a nice extempo presentation on a topic. Next group, please. Okay, please stand closer. So your group number 4, right? So what is your extempo topic? Please start with the topic itself.
Four are going to tell me about the challenges in cash flow management and in personal financial planning. So cash flow management tells about it bifurcates about our income and expenses. If our incomes are more, then we have that right to handle our expenses. But if our expenses are more, then we face financial struggles. So in today's world, there are many people who earn well but are still facing the financial problems due to the improper management of the cash flow properly. So it is important for mainly for the students to understand the financial planning, terms of savings, investment, insurance, even for the business owners and the working professionals.
So now let's move on. What are the challenges in cash flow management? So first and primarily we'll talk about income. Many of the citizens or individuals do not have a regular income. They have irregular income, as most of them are businessmen, private jobs, private sector, not a proper job. So the first and primary challenge is irregular income. As the income is not regular, they face challenge in managing their cash flow. Also, the second one is EMI, credit card. In this challenge, it is we can say that how much we earn, the more is spent due to credit card and EMI. That is equated monthly installment. People mostly buy something, means take a house loan, car loan, and then regret on buying that specific thing. So this is one of the challenge. Third is obviously inflation. As the inflation rises, the money value reduces, and it is one of the challenges. And the fourth and the most important is not proper managing your cash or selling. There must be a proper or what you can say, a proper tool or characteristics through which you properly manage your finance. Or also you can try and adapt to an investor who can help you to adjust or make your financial expenses.
So I will be speaking about the challenges faced in personal financial planning. So when it comes to personal financial planning, the major challenges faced is the lack of financial knowledge. Most of the people do not have the understanding of how much to save, where to invest and when to invest. Now visit SIPs, mutual funds or insurance policy. This creates a big problem in personal financial planning. The second challenge faced is the lack of clear financial goals. Either it be short-term financial goals or long-term financial goals. Not having clear goals can affect in the planning process of the personal financial. So next challenge will be the saving habits of the people. Many people have the mindset of saving later and enjoying right now, but that later never comes. So people do not have enough assets to save for their future planning. Additionally, depending too much on credit cards or loans can have like a long-term debt problems, which can also affect in the future financial process.
I will be talking about impact and consequences. If cash flow is not managed properly, it can lead to stress, anxiety, and financial insecurity. Poor financial management can lead to no proper savings, no retired planning, and inability to handle emergency like medical emergency, and difficulty in achieving life goals like buying a house or children's education. Financial mismanagement can lead to family disputes. Financial management is important as it is not about the money, it is about the financial peace and financial security. Thank you.
To overcome financial challenges, we should follow this important step. Prepare monthly budget to control spending, track income and expenses regularly, build emergency fund for unexpected situations, save at least 20% of income every month, invest wisely after proper research and planning, avoid unnecessary loans and debt. Financial planning should start early in life. Even a small amount of money can grow into a large wealth over the time because of power of the compounding. In conclusion, managing cash flow and financial planning is not an option but a necessity. If we control our money today, money will support us tomorrow.
So, looking at after hearing you, I feel that you can still, do good from your your study. Like if I'm giving you one particular case like a situation, say for example, it's somebody who is earning only 20,000 rupees. He is a vada pav seller, you just, and is earning only 20,000 rupees a month. Okay. Now, obviously, it is a hypothetical example because the person who sells vada pav possibly may be earning lakhs or maybe one and a half lakh around in a month. Okay, net income will be one and a half lakh rupees. But hypothetically, is in the very first stage of his business and is earning 15 to 20,000 rupees. Do you think that at this level, will it be possible for him to make some sort of a saving which, with the help of which he will be able to see a good future?
Yes, sir. Every individual can save until he is earning. Some part of his income should on that should save. But it is a necessity of this era that one should always save.
Thank you very much.
Sir, I would like to highlight this thing that all are talking about the SIPs, investment and insurance, but we are forgetting about our tradition. Every Indian family has that person, if he is earning 20 rupees, he still saves 5 rupees. That too in a piggy bank. And that too we teach to our children, and you have to say at least 1 rupee in a day. That will be like, you will at least save 30 rupees a month, and it will help you in the future. So that tradition we can implement here if that person is earning 20,000 in a day. So every Indian family has that something or the some amount he has to remove it as a saving. So that is our older tradition which is going when even the digital platforms were not and SIPs were not. So that thing we can.
Very nice one. Next group, please. We are still going to be there because I'm going to have one small question on capital budgeting, which will be having relevance from, because that will be a comprehensive question wherein we will cover all the concepts of capital budgeting.
सर कैमरे पे देखने देगा
एकदम प्लीज
प्लीज सर आई कार्ड देंगे
Okay. So, without your personal introduction, you will be directly jumping on your topic, and you will try to sum it up in a shortest span of time. Who will start?
So, good evening. Our topic is insurance products have helped in for personal financial planning. Insurance has changed drastically over the span of so many years. First, insurance used to only be a safety net during unforeseen events such as death, illness, accidents, etc. And it used to be have compensation during emergency. But over the span of so many years, it has drastically changed into more of an investment purposes as well. When people are thinking of insurance more like an investment, retirement planning, and just as saving opportunities and wealth creation, which first used to be a standalone product like safety net, but now it has become more of an investment purposes as well. Now, so many products such as ULIP, safe riders, then digital insurance and retirement planning. These are the few opportunities where they can as well as save the money and invest. Where nowadays in globalization and other aspects like inflation is increasing and the world is evolving and safety is a very big concern and investment. So people are more involved into investing in such aspects and due to digitalization where they can do premiums online and pay compensation, they can call anytime insurance companies, which has made these processes more simpler.
So I'm going to talk about the objective of this. The basic objective is to understand the modern insurance, products and how they help in financial planning. So it helps in learning how insurance helps individual manage risk while also supporting the savings, insurance, investments and retirement planning. It aims to understand the different types of insurance policies and their benefits along with the impact of digitalization in insurance. The another objective is to see how insurance helps people to achieve financial goals such as education, home ownership or even retirement. And finally, it also looks at customer awareness of new insurance products and identifying the trends in the insurance market.
So I'll tell you how these products helps us in the modern. First is the retirement planning. Risk policies help us in modern retirement planning as modern plans, earlier plans used to have the money of the death, whereas the modern plans help you with the hospital bills, accidents, income losses, etc. Secondly, it gives us wealth creation. Today we have unit-linked insurance plans where we get maximum, a part of our premium goes towards our life cover, whereas other part goes towards equity and debt funds, and it's invested and overall your money goes apart from keeping your money in the bank. Thirdly, we get premium mature plans have annuity as well as pension plans which helps in future income. Thank you.
Let us understand the types of investment insurance. There are two big types of insurance, that is life insurance and health insurance, general insurance. So life insurance, under life insurance is called as term insurance, which covers the pure protection plan, which means if the person dies, then only the insurance company will pay the funds. If not, they won't give you money back. Second is endowment insurance. This plan is mostly for many of the middle class people because they have the insurance plus the saving that they get after the maturity period or a person dies. Third is whole life insurance. Depends upon the whole life, how many years we are going to stay. Then fourth is very important for the retirement people. This pension and retirement plan, they get a chance to safely, don't have to depend upon their other people. They get income after their retirement. Second is the general insurance. It covers other than the life. First is the health insurance. Health insurance covers the hospital and the medical billing expenses. Then comes our second motor insurance. It covers all the damage or accidents when a vehicle happens. Third is home insurance. Home insurance protects the owner for a home theft or any damage over. Then fourth, fire insurance helps cover insurance under the covered due to a loss. Then other than this, there are few types that are marine insurance. Usually the company have take this marine insurance to protect their shipping and all. Then it comes business insurance as well. Not only companies take this insurance to protect their business property and all their assets.
Better financial protection. It is protection from life, health, life, and accidents and emergency funds. It reduces burden in emergencies. Second is wealth creation opportunities. In modern dual IPs, that is unit-linked insurance plans, it offers investment opportunities. Third is customization and flexibility. You can customize your premium amount and tenure as per your needs. Fourth is tax benefits. Premium qualify for tax reduction under section 80C. Fifth is easy digital access, online comparison and quick analysis. Next are disadvantages. First is complexity. New insurances are a bit complex. Second is market risk. As this insurance depends on the share market, it will fluctuate and have no guaranteed returns. Third is high premium cost. The premiums are a bit higher than compared to normal insurances. Mis-selling risk. Agent may sell unsuitable insurance for commission. Third is long-term commitment. Surrendering early, the result is
So I have one question to you guys. Do you really think that in India, almost everybody is having insurance cover? So if you are become like you people, maybe wealth planner, later on possibly you may be earning high good amount of salary. How many amongst you personally are having life insurance cover on your own life? Everyone amongst? How many amongst are you having mediclaims? You are having mediclaim. Very good. So what one good thing which you would like to tell to the masses who is sitting over here? Very nice. Good. Thank you very much. Which is the last one? I think last one, no? Second last. Good. Good. God bless you. Go with the Melbourne if you get an opportunity. So stand little closer, like girls at least can stand little closer. Okay. Cover yourself like in a group and without telling your personal introduction, like tell me what topic you are going to talk upon and who is going to start.
not aware of investment options like is written about how the inflation is going to be rise in coming years. And especially in India, education about financial planning are not properly given, especially in our schools. Financial planning, financial education is not many people are aware of that. And because of these things, and the lack of financial awareness are
Who is going to talk next?
Lack of proper planning and guidance. Many people invest without any proper planning and guidance, and they do not review where their money is going and where they have invested. Many people need to review where their money is and do proper follow-ups on it, make changes according to the changing income and economy. People need to invest. People need to invest by planning and by planning like saving for education, buying a house, and for retirement. People just come under the influence of friends, family, and even social media, and do not think about the risks, and just invest and suffer losses. This is one of the reasons because India is not successful in investment planning.
Who is going to talk next? Who is going to talk next?
People often make investment decisions based on emotions like greed and greed instead of proper planning, which may lead them to loss. When the prices in the market rises, investors become overconfident and invest more amount in market before getting a proper before doing a proper research, which may lead them to purchase the investments on higher price. While when the market is down, stock markets like Bombay Stock Exchange or National Stock Exchange, when they have a sudden fall, people start buying. People get panic and sell their investments, which leads them to actual loss rather than the temporary loss. Proper investment requires discipline and patience.
Who is going to talk next?
Lower taxable income. The large section population in India earns just enough to meet their daily expenses, and due to lower unstable income, people find it difficult to save regularly, which makes investment planning unsuccessful.
One of the major reasons for investment planning is unsuccessful in India is short-term mindset of investors. Many people expect quick and guaranteed return from their investment, but they focus on short-term return rather than focusing on long-term return, like education and wealth creation and many more, etc. Due to this short-term mindset, people withdraw their investment when the market goes down, and invest again when the market rises. So due to such market fluctuation, investment leads to losses increases and returns reduces. So, and this happens due to trends and rumors on social media, related friends and all. So we should focus on trusted investment companies like mutual funds, SIP, and this will help people to and people should also focus on long-term market plans.
So now looking at the market situation, one last question to all of you guys. You saw how the market is like fluctuating. In last couple of months, you have seen how the gold price went up like anything, like it surged like anything. It was like a tsunami for the people who really wanted to buy a gold. Uh, and there were many people who bought the gold, right, at very high price. Like there are many people who are crying now because the gold price have come down. What do you think that since the economy is going, our respected prime minister is eyeing for 5 trillion economy, do you really think that the challenges are still going to be there as is, or there will be some kind of an improvements? What's your opinion? Opinion only. We don't want any facts and figure. What you feel?
There must be improvement in economy and budget plannings because nowadays market prices are going very high and people are struggling to earn money right now and especially youngsters and all are finding it hard to find jobs and opportunities.
There must be many employment opportunities as well so that many people can work and
Yeah, good. Got your point. Very nice. Thank you very much. Who is the last one? Okay. The last one, I would request the last parent. Sign, please. Sign across. Yes, yes. Stand little closer. I'm not able to cover you all. So you're the last group of this particular session. What's your topic and who is going to start?
The topic is investment in equities versus gold. The differences between stability and, for example, the Nifty 50 companies have shown a 11 to 14% return for more than 30 years with the law of compounding. Gold, on the other hand, has been useful in cases like inflation, economic uncertainty, etc. Nifty 50 for example, if you own a part of the company can innovate, expand, and can generate income. Gold on the other hand doesn't generate income or grows like a company. For example, if someone is in the age of 30s, I would suggest them to make sure the majority of the portfolio is equities because they can still earn more and they can upgrade their skills and have a more earning potential. Those who are close to retirement, I would suggest them to make sure the majority of their portfolio is made up of gold because gold helps in wealth preservation and stocks in long term helps in wealth growth.
Both are popular investment options like gold investment and share investment. Now it depends on how we invest. Gold investment is preserving gold wealth.
Captured.
Gold investment depends on preserving wealth and share investment is fluctuating, which means taking risk and it helps in making growth in the wealth management.
Wealth.
While gold provides safety, it does not generate higher long-term wealth. Whereas share market allows us to invest in various companies of different sectors. Historically, share market has given around 12 to 15% of return on long-term basis. Therefore, I would say that share market is more liable for investment creation. Even if we only focus on wealth creation, share market easily outperform gold with the help of compounding. Investment in stock market means buying a investment in stock market means share market means buying the shares of a company. Or if we come to the gold, we can buy a physical gold like ETFs like SPDRs, gold shares. But as compared to the gold, share market is more preferable. Like it gives more return for long term. and gold is better, but for short term and when the market is down, as it doesn't give that much amount of money as like the shares. So if you just want to grow more money, then invest into the shares, and if you just want to be safer side, then invest into the
What stock investment, the share market investment, investing in stocks like the ownership of the company. Some examples can include Nifty 50, SPE 500. So coming about the advantages part, it gives long-term returns and regular income in the form of dividend. Coming in the form of limitations, there is a risk side of investing in stock like there is a possibility of short-term losses.
Live chalu hai.
And there's a possibility of short-term losses, and it requires patience and ability to take decision as compared to gold. Talking about the gold investment, it is the traditional form of investment in India. Many people in India prefer investing in gold. Golds may include time, jewelry, coins, digital golds, sovereign bonds offered by governments. So talking about advantage, it can be used as an asset during crisis. And talking about the limitation part, it doesn't give higher returns as compared to stock. It gives lower long-term returns, and it requires storage if you're buying physical gold.
In conclusion, it would be, according to 2026 market, it would be wise to invest. It would be wise to invest in both the gold and equities market, as we see the youngster, they have longevity, investment horizon, consistency, so they invest in stock market equities. But whereas the people who are coming close to retirement, who are planning their retirement options open, keeping their options open, they invest in gold. On an average, people in 60 to 70% of the investments are done in equity market, and 10 to 20% is done in the gold.
So thank you very much. It was really an awesome experience for me as well as you. This may be for a person online, right? And I feel that this particular will remain forever in your memory. I would give you some very nice. It was, but what I want to ask you is that when you were comparing about a gold and this one, and Etsy rightly said that the people who are coming closer to their retirements are usually going with the gold investment. The reason is safety, but obvious. Because people don't want to lose their money. But now what is happening is that the price fluctuation which is happening in the gold due to the uncertainty which is happening at an international level. What do you think? Which one will be better? Because now see, almost a week back the market was it was going down. Now all of a sudden it came up. Now you might have already gone through some news that USA is already preparing to once again attack on Iran. In a coming situation, what do you think? What would be the best investment? Or would it be a win-win, you need to put some money in the mutual fund, put some money in the... Because now mutual funds also have come with the advertisement. You must be knowing that, that particular person is coming and he is telling that, what is his name? Rohit, I trusted you and I started investing in a mutual fund. But now mutual fund is also not, they are also doldering. Now what is your opinion, being the representative of a Gen Z, if you are looking at your retirement and looking at all this kind of a situation, which investment comes in your mind, either equity or gold? You will answer one by one. Everybody will have instantly gold or in equity. Very nice. Thank you very much. Have a nice time. Thanks a lot. So with this, I am closing up this. Now the time is not allowing me to take this one, but then I would be taking one online lecture for capital budgeting. I hope you all will be joining on that online lecture. Okay, thank you very much. Bye-bye.